Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to The Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. The S&P 500 and private market are soaring. Almost all ARK ETFs are expected to be greatly affected in 2021. Cathie has never seen anything comparable to that case, and she sees the indexes as a major bubble. She even said that she is a deep value manager, due to the fact that the prices in innovation are ridiculously low, whereas index funds are about to crash significantly. In this video, we'll explain why Cathie believes index funds are in the midst of one of the largest bubbles ever in history. Index funds are widely regarded as the holy grail of investing. Despite the fact that index funds have low costs, most active fund managers fail to outperform the S&P 500. Index funds, according to Warren Buffett, are the best thing for most individuals to buy. This sounds nice, but index funds' popularities may be feeding a bubble. Inflows into ETFs hit a new high of $1 trillion in 2021. That is a significant sum. However, the fact that the inflows have been so large may be a self-fulfilling prediction. The S&P 500 is basically a collection of stocks that Vanguard closely monitors to generate an ETF. Money flowing into the S&P 500 inflates the valuations of the companies within it over time, generating profits on its own. In short, one of the reasons why fund managers struggle to outperform the S&P is that rising inflows are inflating the S&P returns. This is comparable to ARK Invest because if investors sell the ARK ETF, the stocks within it will also sell off. Assets under ARK's administration have dropped from $22 billion in November to barely $16 billion now. There are several factors that influence valuations, but regardless of the analysis, valuations are at all-time highs. Those of you who follow the stock market are probably familiar with the Buffett indicator. The Buffett indicator is a ratio that takes the total market value of the US stock market and divides it by the annualized US GDP. This ratio is currently at 213%, which is much higher than the average. The Buffett indicator would still be considered overvalued even when compared to the long-term trend line that is shown on the screen. The Buffett indicator is 2 standard deviations above the trend line, as shown in this graph. This suggests that we're only at these valuations 2% of the time in this data. Some might even link these equity prices to inflation, but a closer examination reveals that the correlation is not positive but is negative. Inflation peaked in the late 1970s and early 1980s, reaching rates of over 10% at one time. Maybe you already know this period. It's known as the Great Inflation. The Buffett indicator was actually at all-time lows at that time. If we look at the graph with standard deviations, we can see that the late 1970s and early 1980s were the lowest points. As a result, attributing increased valuations to inflation would be difficult. The P/E ratio of the S&P 500 is likewise at record highs at around 29, while the S&P Shiller P/E ratio, which adjusts for inflation, is at 39. Cathie Wood's statement that index funds are in a bubble may seem peculiar, especially because she's often regarded as the poster child for the modern tech bubble. Her claim also seems right because there are several investors and fund managers that are investing in the S&P for a guaranteed 10% annual return over time. Cathie thinks the S&P will be perceived as much riskier than expected, especially when companies in the S&P face disruption.
I think that the traditional benchmarks talk about risk because of these innovation platforms, DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technologies. Because those are going to rip through the traditional world order and disturb it mightily, that those benchmarks are probably where we're seeing the bubble today. I know what I find so interesting about movements in the market today is The fear of interest rates and inflation picking up really started in February of this year as people were getting vaccinated. And the markets went after our strategy to express the risk and basically shorted our strategy. What I find so interesting about this is that the market's multiple, broad-based market, so S&P's multiple on next year's earnings is at 24 times. NASDAQ's is at 31 times. These are near record highs, except for the tech and telecom bubble. If inflation is really the risk out there, why isn't the entire market's multiple coming down? I remember when I started in the business, late 70s, early 80s, Art introducing me to Capital Group on the West Coast, and I'll be forever grateful. Back then, I think by the end of the bear market in 1982, the market's multiple was down to 6. I just mentioned that we're up to 24 on that basis right now.
For instance, you disagree with Ark Invest and believe the S&P 500 is a massive bubble. Small and mid-cap equities, particularly those with a market capitalization of less than 10 billion, will offer the best returns. Here in the graph shown on the screen, the S&P 500 large cap P/E has climbed from around 11 in 2011 to roughly 21 now. The S&P mid-cap index, on the other hand, has only gone up from a P/E of 13 in 2011 to 16 today. The S&P small cap index has become even more compact, going from a P/E of 13 in 2011 to 14 today. These three graphs clearly show the disproportionate increase in the S&P 500. As a result, Ark Invest looks for a company. The majority of them aren't even listed in these indexes. The market capitalization of Ark's largest positions, for the most part, is larger than $20 billion. Considering Ark's low correlation with the indexes, Cathie discovered that if the fund manager ARKK allocates a small part of their portfolio to Ark, the returns will rise while volatility falls.
Because most asset allocators are short innovation in the public equity markets, that if they were to include our portfolio, let's say our flagship portfolio, perhaps 10% of their equity allocation to our flagship, and then if they were to use the benchmarks for value and growth, over a 5-year period, and we did this study based on facts, our own experience, over a 5-year period, Ark's strategy would increase returns and lower risk because the correlation of our returns with other strategies is very, very low. So that's the primary reason we depend on asset allocators, advisors to allocate as much or as little to our strategy. One thing I will say is, given the massive amount of innovation taking place right now that is going to be highly disruptive, we do not believe that most asset allocators have enough allocated to innovation.
You may be wondering how adding a volatile fund like the RAKK might reduce volatility. Low correlation is the explanation for this. If the S&P 500 rises in the short term while ARKK falls, both funds oppose each other, resulting in lower short-term returns than simply holding the S&P 500. Moreover, if ARK rises 20% and the S&P 500 falls 5%, the net return will be lower than simply holding ARK. Short-term fluctuations will not have a substantial impact on the long-term return. So including a fund like the ARKK in the S&P 500 could help to reduce short-term volatility while potentially enhancing long-term returns. We already discussed the S&P 500's P/E ratio being at all-time highs. The Ark Invest P/E ratio appears to be significantly higher than the S&P 500. However, Cathie's estimates suggest the contrary. She discovered that even if one predicted a FANG-like multiple 5 years out, Ark Invest would still grow at a rate of 40% per year over the next 5 years. Future multiples show that Ark Invest-related stocks are currently trading at big discounts. That's why Cathie thinks she's a deep value fund manager, since she's buying equities at ridiculously cheap 5-year multiples. It may not appear that way at the moment because current multiples are high, but she believes that the magnitude of future growth will prove to be different.
Now, you're going after multiples in our space, and what has happened, the depreciation in our stocks from mid-February to today has not done anything to our forecast. We're now just getting our companies and our stocks at lower prices. So in mid-February this year, as we did our 5-year forecast, and we assume massive multiple compression, during the next 5 years to something like FANG multiples, EV to EBITDA in the 18 to 20 range. When we did that in February, at the peak of our strategy, the compound annual rate of return we expected from our portfolios was roughly 15%. Today, doing that analysis, some of our projections have increased. The compound annual rate of return we are expecting is close to 40%. So in February, we were expecting a doubling over 5 years. Today, we're expecting nearly a quintupling over 5 years.
In comparison to innovation-related stocks, Cathie would obviously conclude that the index fund is excessively overvalued. Michael Burry would also agree, having previously criticized the index fund bubble and claimed that small-cap companies offer the best opportunities. Investors are throwing their money on FANG without evaluating every specific company, similar to what happened before the 2008 recession. Burry believes this is harmful and that index funds would suffer as a result. And that's all about the explanation of the index bubble. Would you still continue to invest in an index fund? Share your thoughts in the comment section below. Thank you for watching. So that's it for today. I hope you learned something from today's video. And to get updated with the next videos, don't forget to hit the notification bell. See you next time.